Hello, everyone. Nice to see you again today to continue our lecture series. And our discussion today would be about the cost of capital. Okay. So, um, so our theme today is the cost of capital. It's very famous and important input in the feasibility study or business valuation or any kind of valuation that we do in valuing assets or businesses, even startups and all other things. So cost of capital. So if you see the terminology here, the cost of capital, I have to start the discussion from the word capital. Here, capital. So what is capital? Or if I rephrase my question, who supply capital? Who supply capital? And the answer is, of course, our investors. Okay, so capital is supplied by investors. So the next question is who our investors are. So who are our investors? And of course, our investors could be, you know, uh, could be our creditors, could be owners, and all other things, right? But uh, most basic types of investors are have creditors, so people who lend us money. We borrow money from those entities or people, right? We could borrow money from a bank. We could issue bonds and sell them to our bondholders. We could issue commercial papers and sell them to our creditors. We can borrow money from third parties, maybe from parent companies, from sister companies, and so forth. So our creditors. And the second uh, typical type of investor is the owners or stockholders, right, in corporation, stockholders in a corporation. And of course, we have many in the middle, right? The mezzanine uh, financiers, right? Mezzanine money providers, like preferred stockholders, warrant buyers, and all other mezzanine type financiers. But again, the two basic types are creditors and owners. Okay, so you can see from our definition, so investors consist of, again, two basic types: creditors and owners, and of course other somewhere in the middle, the mezzanine financiers. Why are they called investors? Another important question, right? Why are they called investors? Because they give capital. So you can, easily imagine the word investor there, because they invest, they give capital. However, there is actually one requirement, one important requirement that really determines that they are investors. And that key determinant is the required return that they are asking, right? So they require a certain rate of return. So they don't give the capital for free. Now you can get the basic idea, right? So they don't give the money for free because uh, yeah, there are possibilities that the people who give money to a certain entity might not ask something in return. So if I draw this, simple balance sheet, assets on the left, and we have liabilities and equity. So we could easily and safely guess that almost all items on the right side of our balance sheet are capital, almost all items. But of course, right, in reality, they are not all, right? Not all of them are capital. So some of the items are not provided or are not financed by investors. So they are not capital, right? So you can see a simple example here. On the liability side, we have certain types of liabilities. Maybe the easiest item to imagine is accounts payable. Or accounts payable. So we buy materials from our suppliers, and most of the time the suppliers don't charge any interest if we don't take the discount period. So again, most of the time, if we pay our suppliers within certain days, maybe 10 to 15 days, we will get a certain discount. However, if we don't take the discount period, we're still able to pay the suppliers maybe within uh, 2 months, 3 months, or so forth. And usually they don't charge interest. So we could say that the suppliers are not investors, of course, right? But they give us an opportunity to maintain cash longer. So essentially to borrow money, of course, in a short period of time, and we don't pay anything, right? So they earn nothing from us. So they require nothing from us. Of course, we could argue that uh, although we don't pay us explicit and explicit interest payment, but we lose the opportunity to get cash discount. Of course, we could argue that way. And again, in finance and economics, we have a way to incorporate that into calculation because we have an implicit cost. However, again, if we are talking about the explicit required rate of return, that accounts payable is not part of the capital, right? And also we have deferrals, we have deferred expenses, right? Uh, Maybe deferred salaries, deferred uh, utilities expenses, and so forth. So uh, we could maintain cash longer. Essentially, we are borrowing money, but again, the providers of the lending, the providers of the credit don't require anything from us, so they are not capital, right? And although they're giving or they allow us to use the money for a longer certain period of time. And also on the equity uh, part, we might have like special accounts, right? For example, in certain industries, we might be able to attract, the contribution or uh, CSR or some donation, right? So let's say two semi-profit industries, such as education, right? Education or uh, healthcare, right? And this is very important right now, the healthcare industry, because of the wicked virus that being fought by humanity right now. So these two examples of industries that might attract special money, right? Could you imagine if a normal person having a lot of money suddenly goes to a manufacturing company to give money or to donate his or her money to a manufacturing company? That's unthinkable, unheard of, and it doesn't make sense at all. But again, in education and healthcare industries, we have the possibility to attract this kind of money, right? So we never know, right? Maybe in the past, sometime in the past, your hospital, you know, there was maybe a young boy came to your hospital dying, right? And then this young boy collapsed in front of your hospital, and you, as the owner and the executive of the hospital, decided to take him in. So it was like just an act of compassion because deep in your heart you knew or you realized that this boy might not be able to repay you anything, even if he was well later, but you decided to take him in, right? And it turned out that actually the boy got well, right? So as expected, he no the boy didn't have money, didn't have any family members that could pay you the amount of healthcare expenses spent in your hospital. So you just let the boy go, and uh, unbeknownst to you, 20 years later, this boy has become a billionaire, and maybe he might come to you and just throw money on your table because this guy has plenty of money and has become super rich person. So this kind of donation again would be recorded on your equity side or equity item, but not capital, because the money is given by someone who doesn't require something in return. So the person doesn't require or doesn't ask for any compensation or any reward, right? So we sometimes we call the item here fund. It might ring a bell, right? We have uh, the endowment fund for education. We have children fund, and for hospital, we have certain funds for certain diseases and so forth. So again, in essence, let me repeat again summarize my discussion here. Almost all items on the right hand of your balance sheet are capital, but in reality, it's not all, right? Not all of them are capital because some of them are supplied by people or entities who don't require something in return. So they don't ask for any required return from the money that they have given to our company. Okay, so coming back to our story here, why are they called investors? Again, because they ask something in return, right? This actually more important determinant. They ask something in return, so it's not free. That's why, coming back to our story, the capital is not free. So there is a cost of capital, because the capital that we employ in our business, our investment, our endeavor in making money is not free, right? It's supplied by people who want something in return. That's why there's a cost of capital. So if I try to make a little conclusion here, cost of capital, right? Could imagine now we have you have a cost of capital because the capital, again, the capital that we have, the capital that we receive and employ is not free, right? So in the same analogy, right, the cost of capital is the required return by who? By investors, of course, right? Okay, so required return by investors. See, it's the same thing, but is viewed or seen from different perspective. Right? Cost of capital from outside, from our company, and from the perspective of investors, this is the required return, right? Required return by investors. Okay, so again, one more time, cost of capital is essentially the required return by investors. Right? It's a cost to us, right, as a company, as a business entity, what is the required return from the perspective of our investors. Again, who are our investors? Our investors are the financiers, the creditors, the owners. Why are they called investors? Again, because they are something in return. Okay, now we'll go deeper into the cost of capital components. Components. So cost of capital has components, right? Because we have uh, many types of investors. So let's start from the first one, first component. So we have cost of debt, cost of debt, right? So we use debt. Most companies use debt, and we'll see a myriad of benefits offered by debt financing in maybe our next lecture or subsequent lectures that will follow. So cost of debt, so it's supplied by who? Of course, it's supplied by creditors, right? So by the same token, we can say that cost of debt is the required return by creditors, right? So we borrow money from the creditors, right? So cost of debt to us is actually the required return by our creditors. So you see the analogy, right? We always compare things at their levels, right? At the same level. The cost of capital is the required return by investors, all of them, right? But the first component, cost of debt, is the required return by creditors, right? Required return by creditors. Okay, so how to determine the cost of debt or the required return by creditors? Now imagine again, right? So if we are asking or if we are estimating the cost of debt, uh, essentially we are asking like how much is the required return by creditors? So what are the approaches to estimating the cost of debt? So there are many ways, right? There are easy ones, there are harder ones, but what's the easiest? Yeah, also the laziest, but the easiest one. How is it? Just ask, right? Ask your creditors. Creditor could be one, could be more than one, right? Ask your creditors. So you simply submit your proposal to a bank, right? Or again, you can try to issue certain types of securities like commercial papers or a series of bond. And of course, your underwriter or your underwriters will help, estimating uh, the coupon rate that has to be offered to your potential buyers. So just ask, ask for a quote or ask for quotes from many banks. Maybe you can compare, submit your proposal. So this is the easiest, and I would say also maybe the most valid way. So we can hardly find something like this, right? Easy, lazy, but relatively accurate, or even we can say the most accurate one, because the quote really comes from your creditor or your creditors. So this is the one of, I think, the most valid methods. However, this is the thing, right? If we say that this is the easiest and also probably the most valid way of estimating the cost of debt, why don't all companies use this method in estimating their cost of debt? Right? Quite intriguing, right? And the answer is, of course, uh, there's another dimension that we have to consider or put into consideration, right? And that particular factor is the secrecy, right? Secrecy and or confidentiality, right? So suppose you have a new project, right? Quite potential one, and you project that the potential new venture would be relatively profitable and would be long lasting. So if you make a proposal and you send the proposal to a bank or many banks, most likely the information will leak out. Of course, we could argue that as bankers, and based on the was it code of conduct and ethics for bankers, so all of the bankers have to keep like confidential information, right? They shouldn't, share the information to outsiders. However, you never know, right? You never know, and suddenly you find out that in your city, in your particular place, even cats on the street know that you have the new project, So it's quite surprising, but again, who knows, right? So not all companies would trust, the potential creditors. Of course, although this is the easiest and even the most valid approach to estimating the cost of debt, because again, the quotes really come from your potential creditors. Okay, so the first method. So if you choose not to use the easiest and also the most valid method, then you have to think about other approaches. Okay? So maybe the second approach would be to estimate the cost of debt by yourself by using comparables, right? Have comparisons. Uh, so for example here, right? So you don't want to ask your candidate or potential creditors, but you try to estimate by yourself. So you could imagine maybe you see another company, right? Another similar company, or another company that has a similar project like yours, right? Like this one, and you're seeing that the uh, what is the yield to maturity or the yield of the borrowing for that project. So again, we are using the comparison here, right? So let's say this is our project, right? This is our project. So we observe, right? We observe that another company has uh, a project with similar characteristics, right? They have a project with similar characteristics, and this project already uh, is already financed by a series of bond, right? So it's already outgoing, existing or outgoing bond, right? And you see that we got the information. The bond is will still be outstanding for the next maybe 7 years, right? 7 years, but semi-annual payment, right? And then the coupon, let's say the bond that the other company has issued pays a coupon rate of, to make it easy to imagine, like 10%, right? 10%. And again, the nominal value or the par value, say is 1 million. And the par value of piece is 1 million. Right? So the current price, right now is maybe 980. Okay, so uh, with this information, right, these pieces of information, we could try to find the yield. Right? What is the yield to maturity? So again, yield to maturity. Uh, if you don't remember, you can go to my lecture on bond valuation. So with this information, we could estimate the yield. Yield is the result that you hold if you hold the bond until maturity, right? Yield to maturity. So it's like the real result that you enjoy if you hold the bond until maturity. So we could draw this. The current price is 980,000, right? And at the end, so we still have 7 years to go, but semi-annual. So we have 14 periods, right? We have 14 periods. At the end of the 14 period 14, we will get 1 million, right? And of course, the coupon rate is 10%, right? So 10% of 1 million is 100,000 per year, but it's paid semi-annually. So each period will get 50,000, 50,000, and so forth, right? 50,000, 50,000, 50,000. At the end of period 14, we'll get 50,000, and of course, the uh, par value at 1 million. Okay, so of course, we are not going to calculate by hands, but just yeah, try to remind you of the manual calculation. So uh, the 980 is the present value, right? So should equal the each of them, right? So 50 from the first period, right? 50 divided by 1 plus. This is what we are looking for, right? The first period, right? This one, and then the second period, right? 50 1 plus yield to maturity to the power of 2, right? And sorry, and so forth, right? The third period, the fourth, and so forth, and the last one, 1,050,000, right? 1 plus yield to maturity to the power of what's that? 14, right? Period 14. Okay, so of course we are not going to calculate by hands. So we'll use the Excel. So we'll find potential, then rate. Okay, number of periods, 14, right? 14 periods left. 7 years, but semi-annual, 14 years, 14 periods left. The coupon payment is 50,000, right? The present value right now is 980,000. So we give the sign minus because we assume that when we buy the bond, we have to pay, right? Have to incur cash outflow. And future value at the end is 1 million. Okay. So we find out that the yield to maturity is 520 per period. And if we use the APR, so to annualize the 6 month yield to maturity, so we simply multiply by 2. So we are not going to use the effective annual rate, but we just use the APR, or the annualized or annual percentage rate, right? So the yield to maturity for 6 months is 520. So we annualize it. So we find the APR of it. So 10.41%. So coming back to our story here, so the 10.41%. So we could assume this way, right? So another project by another company is having a yield to maturity of 10 something, right? 10, what is it again? 1041. So we are saying that if we are going to issue a bond with similar characteristics as the other company's bond, then most likely when we issue this bond today or right now, the coupon rate that we have to offer is about the same, right? 1041. So we could assume that this would be the cost of debt if we are to issue this kind of bond, right, with the same risk characteristics or the same characteristics as the other company's bond, right, for its project. Okay, so this is the second approach. Right? Uh, so we compare again with another company or another company's project, and we try to find or estimate its yield to maturity, right, from another project by another company. So we are assuming that if our project is relatively similar or resembles that of another company, then if we are going to issue the bond, this kind of similar bond right now, then the coupon rate that we have to pay would resemble the yield to maturity uh, uh, like earned by the other project from another company. So the other approaches, maybe the third approach for the cost of debt would be another lazy method. So maybe we can use whatever the risk-free rate, right? The rate given or rate offered by a government security, right? Uh, it will be different from one country to another. We have the T-bill in the United States. We have SBN or SUN in Indonesia, and so forth. So risk-free plus like a premium, right? And this premium, you could define it in whatever logical way that you could argue, maybe from Damodaran's website. I know it's lazy, but I mean, it's also executable if you want. I want to save time. You don't want to tell anyone when you make this estimate. I mean, you don't need to share information with potential creditors and so forth. But again, the risk-free plus premium, again, so you can use this way, of course. So again, cost of debt. Why are we doing this? Is to estimate the cost of debt. And what is the cost of debt again? It's a required return by creditors. Right? Required return by creditors. Okay, so let's continue with the second component. So the second component, uh, maybe we can use an example of a mezzanine financing. Mezzanine means it's not debt, but it's not equity either, also something in the middle. Right? So you could use an example, cost of preferred stock. Of course, you can use, if you want, another example like cost of warrant and all other mezzanine financing. But we'll talk about the hybrid financing later in another lecture series. The cost of preferred stock. So you could imagine, what is it? Cost of preferred stock to our company is essentially the required return by, of course, by preferred stockholders. Right? It's always you know the same analogy from one type to another. So cost of preferred stock is a required return by preferred stockholders because they are the money providers. Right? Okay, so I hope you still remember the some main differences between preferred stock and common stock. Right? So preferred stock is something in the middle. Right? Something in the middle. It's not that, but it's not really equity. Of course, in accounting, we have to include preferred stock into the the recording of equity. However, in finance, we really see preferred stock differently from common stock, right? So it's not common equity, but preferred equity. So what are the main differences? I mean, the most obvious difference would be in terms of dividend payment, right? Or the was that the provision of reward, right? So let me draw this again. We have liabilities and common equity, right? But we have mezzanine here, for example, preferred stock. So a simple question, right? Uh, if we borrow money from a creditor, right? The first question is, uh, are we required or are we obliged to pay the interest payment? The answer is of course yes, right? Okay, so we are obliged to pay the interest payment. Right? Second question is, are we required to pay on time? And the answer is yes. Right? Okay, so both questions produce a yes answer, right? So we are obliged to pay the interest payment, and we are also obliged to pay on time, because if we don't pay on time, and if the if a creditor doesn't approve the late payment, then we could be sued, right? They could sue us to the court for whatever restructuring or bankruptcy and anything, right? So what about the common equity? Oh no, but I'll start with the preferred equity, the preferred stock, right? So are we obliged to pay preferred dividend? Yeah, the answer is yes. We are obliged to pay the preferred dividend, right? But the second question is, are we required to pay the preferred dividend on time? The answer is no. So we could defer the preferred dividend payment. Of course, we have a lot of like clauses and requirements with respect to the issuance of preferred stock. Right? For example, if we don't, if we have not cleared the preferred dividend, then most likely we are not allowed to pay the common dividend. So there are a lot of restrictions uh, on account of not paying the preferred dividend. So of course, the company will not deliberately delay the payment of preferred dividend, because uh, that will render the company unable to pay the common dividend as well, right? But again, you see the difference here. So we are obliged to pay the preferred dividends, but the dividends could be deferred, right? Could be accumulated to, maybe next period, or even the period after the next, right? What about the common equity? Are we required to pay common dividends? Even the answer is no, right? So we are not even obliged or required to pay common dividend. Okay, so you see the difference here. That's why this is called the mezzanine, or something in the middle. And also you see the order of the accounting recording here. So if something happens to the company and we have to liquidate its assets, then who will get the money first? Of course, after the clearance of government uh, tax deferral, right, or deferred taxes and so forth. After the tax obligation, then the liability holders or the creditors will get the money first, right? And then the preferred stockholders or mezzanine financiers, and later, if there's money left over or remaining, then the equity holders might get something, right? So you see the some main differences between preferred stock and common stock. But essentially, uh, preferred stock is not really equity, but something in the middle, not really debt or liabilities either. So how to estimate the cost of preferred stock? I still remember from our lecture in stock valuation. So we have the first uh, so the first special situation that makes it easier. We borrow from the calculus, right? The first special situation is the constant cash flow, right? Constant cash flow. And why this one fits the characteristic of preferred stock? Because you could imagine most of the time in the close, right, when we sign the close of preferred stock issuance, the preferred dividend is usually constant, right? Right. Uh, Maybe it's determined in the contract that it will pay uh, preferred dividend for the next maybe 10 years, or 7 years or anything. And the amount of dividend is usually constant because it's stated, right? Stated in the in the clause, right? In the contract. So uh, if this fulfills the constant cash flow situation, and you could imagine that the price of the preferred stock, right, uh, can be estimated as a function of the constant cash flow, right? Again, the preferred dividend cash flow is most likely constant and stated, right? The amount or the dividend rate is stated in the contract or in the clause, right? Divided by uh, right the required return by preferred stockholders. So again, I hope you still remember we can use this formula only if it fulfills the constant cash flow scenario. Right? So if we do something with the formula here, so you can reverse it. So required return by preferred stockholders is the constant dividend paid by the uh, preferred stock divided by the current price. Okay, so what is it? Required return by preferred stockholders. And required return by preferred stockholders is the cost of preferred stock to the company, to our company. Okay, so quite easy. So you can imagine a maybe simple situation. If there's a preferred stock that pays, like, say, dividend rate in a contract of say 11%, right? And then the par value, say the par value of uh, the par value is 10,000, right? So immediately you could imagine. So every year, uh, this preferred stock will pay dividend of 1100, right? Okay. And then if you see the current price of the preferred stock, the current price right now, say is whatever, maybe 15,000. Okay, so if this is the case, then you can estimate the cost of preferred stock would be the constant dividend 1100 divided by 15,000. You get certain number. Right? This is just an example, so let me calculate quickly. 7.33%. So this is 7.33%. Okay, so quite straightforward, right? So again, the required return by preferred stockholders is the cost of preferred stock to us as a company. Also, there's a possibility that you want to take into account uh, the fact that if you issue a new series of preferred stock, you might not, or you will not receive the full amount of money to be expected from the issuance because you have to pay for your underwriter, right? Underwriter fee. So you could, if you want to take into account that fact, then you have to multiply the price by 1 minus the fee, right? You can call it what? Flotation cost, underwriting cost, or anything, right? So flotation cost in percentage point. You could imagine, right? If this is a new preferred stock, that out of the 15,000 that you expect to receive, you might have to share maybe 5% of it, 50,000 per share, right? You might have to share, what's that, to divide or to allocate 5% for your underwriter or underwriters, right? So you only receive like 95% of the 15,000 if you, yeah, if you need to take into account the flotation cost. Okay, so we finished the preferred stock, and the third component is the cost of equity. So this is quite special because if you want to uh, go into the details of this one, of course, in practice, we many a time we just use, okay, cost of equity. But again, theoretically, we have before that, what is it again? Cost of equity is required return by who? By equity holders, right? By shareholders, right? By your stockholders. Okay. So cost of equity is a required return by your stockholders. So it has now if we want to go into the details, the first type of it is the cost of existing, equity, or in other words, you can call it, you can call this one also cost of using your savings, right? Your corporate savings or your retained earnings. Right? So cost of existing equity or the cost of retained earnings. So this is quite interesting, right? If you think carefully about it, you have savings, right? You have your retained earnings. So what are retained earnings again? This is the money that you retain from your net income that you don't distribute as dividends. So you get net income, right? So you have to make a decision, right? How much of the net income will be distributed as dividends, or how much will be used to repurchase your stock, and how much will be saved. So the saving part uh, is put under the item or under the what's that, the account of retained earnings. So cost of retained earnings. So if you again, if you think about it, uh, why should we consider it to be the cost if we use our own savings, right? But the answer is quite simple and quite straightforward. Remember that when the stockholders allow the company, right, allow the management to retain certain proportion of the net income as retained earnings, actually, uh, they are saying this, right? You could retain my money. Uh, you could choose not to distribute the net income as dividends to me, as long as you could produce more using the money. You see the logic now? Okay. So although it's our own savings, but again, we should remember that again, the people or the stockholders that allow their money to be retained by the company actually are asking that the money should produce something more than what they could by themselves. Otherwise, they would say, if you are not able to produce, the results that we want or expect, then just distribute the net income, just pay out as dividends, right, out of the net income. So we could invest by ourselves. You see, right? So the retained earnings that we are using or that we are going to use are not free because they are supplied by people who actually ask for results, ask for or even require the results, right? That uh, otherwise should be distributed to them, right, as dividend payment or as stock repurchases. Okay, so you get it right now. So the retained earnings that we are using, again, are not free, right? Because they're again they're provided by people who want or require something in return, right? Cost of retained earnings or the cost of existing equity. Okay, so this also has some approaches, right? So you see, uh, from our discussion on stock valuation, remember there's another scenario where uh, there has been constant growth forever. So constant growth forever. So this scenario is different from the one that we discussed above, right? The constant cash flow. So this is constant growth forever. If the situation fulfills this scenario, then we could do it this way, right? So the price of the common stock, right, right, should be a function of the next cash flow, right? Next cash flow, or if you want to simplify the the case, you can say the next cash flow, next dividend, right? So the P at time zero is a function of the next dividend. Of course, the next dividend is the first period, right? If the current period is zero, then the next period is one. Divided by return by common stockholders minus constant growth forever. Okay, so if we again reverse, right? So required return by stockholders should be a function of next cash flow divided by current price plus the constant growth forever. And you know what is it again? The required return by common stockholders or equity holders. So required return by common stockholders is the cost of common equity to us, right? Of course, the existing one, right? Cost of existing equity, cost of common equity to us. So this is the first approach. Okay, so you can see an example, maybe uh, a situation where uh, the previous dividend, let's say the previous dividend is 250 a piece, right? And then the growth rate, constant growth is expected to be constant growth forever is expected to be at whatever, maybe 5%. Right? And then the current price, is say 5,000. Again, those numbers come from the sky, right? So there's no logic whatsoever. It's just an example. So now we can estimate required return by common stockholders. What is the next dividend? So we have to make an estimation, right? So the previous dividend was 250 and is expected to grow at 5%. Right? Next dividend, right? So divided by the current price, 5,000 plus the constant growth forever, like 5%. So let's calculate quickly. 250. Okay. So we get 10.25%. So this is the required return by common stockholders, or the cost of equity to us. Okay. Okay, so this is oh, the first approach for the cost of existing equity. Cost of existing equity. So another approach would be the famous one, capital asset pricing model. This is another approach to estimating the cost of equity. This is a very famous one, like capital asset pricing model. A model that would be used, I think, forever. Right? So what is it again? The required return, right? Required return on a security, right? And this is a function of risk-free, right, plus market return minus risk-free. Right? This is called premium, right? Risk premium, risk premium multiplied by the securities data. Right? Okay, so for example, we have a situation. If you know the risk-free, then what is risk-free? This way we define risk-free rate as the interest rate offered or provided by the government securities or a government security. Right? And of course, yeah, we talked about this before in the discussion on the time value of money. Of course, a government or a central bank could go broke. See the reality, right? The uh, Greek government or some other countries have gone broke or have plunged into financial difficulties. But again, if you think about it, a government has a lot of methods, right? A lot of ammunitions. If they have like, financial difficulties, they could do many things, right? Borrowing from another country, even printing more money, although it's dangerous, but it has the power, right? It has the power to, uh, you know, uh, to ask the central bank to print more money and so forth. Right? Well, it's not our topic today, but again, risk-free, right? Uh, Rate paid or offered by the government security. And then we have the market return here. So return on a stock index, maybe S&P 500 or Straits Times or Jakarta Composite Index and so forth. So return on a stock index minus risk-free. And the beta, right? Beta is the systematic risk or the sensitivity of an asset's return to the market return. So if you want to know more about beta, you can see my lecture on portfolio theory, especially part 2. Okay, so let's make an example. Let's say we are in a country where the risk-free is about, let's say, 5%. It's getting lower nowadays because of the monetary policy, right? A loose policy to boost up growth, right? So let's say market return. This is also unstable in the current years, let's say 12%, right? And this company or this security has a beta of, let's say, 1.1, right? Pretty close to 1. Okay, so we put into the capital asset pricing model. So it will be like 5% plus that 12 minus 5 multiplied by 1.1, right? So what is it? 12.7%. Okay, so 12.7% against the required return on this security, right? A required return by the stockholders. So this is the cost of equity to us, right? This is the second approach, right? Second approach to estimating the cost of retained earnings or cost of existing equity. And of course, we have other approaches, right? Maybe the third approach would be the another lazy method. So we can say that the cost of existing equity is simply maybe the cost of debt plus whatever premium, maybe country risk premium or anything, right? From Damodaran, from maybe other reputable firms, right? Other reputable consultants and so forth. So this is lazy method. We are not saying that it's wrong, but we are not sure about the accuracy because you just take it, take it as it is, take it for granted, right? Cost of debt plus certain premium, right? So it's another method or approach that can be used. Okay, so we have seen the cost of existing equity. Okay, so this is, again, we have several methods here. Cost of existing, cost of common equity but existing, or the cost of retained earnings. We can use the constant growth forever model. We can use the CAPM, right? Capital asset pricing model. We can use the lazy method, right? The cost of debt plus certain premium. Okay, so now we'll see the second possibility, still cost of equity, but maybe you have to, if your savings are not enough, right? And maybe you try to borrow money, or uh, if the borrowing capacity has been maxed out, then there's a possibility that you have to issue a new equity. So this is cost of new equity. It's the same, right? Required return by our stockholders, but this is new equity instead of the savings or current savings that you have. Cost of new equity, very similar from the constant growth model. Again, I will repeat again. If this fulfills the constant growth forever scenario, then we could estimate the current price of fundamental value as the next dividend divided by the required return by stockholders minus the constant growth forever. Okay, so if I reverse it again, it should equal next dividend divided by the current price plus the constant growth forever. So what about the new equity? So I will change the name for the sake of clarity and to avoid confusion. Okay, so I use the new equity, NE. Okay, so the NE, price of new equity. Right. Okay, now similar situation as the one when we issue, if we are going to issue preferred stock. So similarly here, if you want to issue new equity, then you have to pay, right? You have to pay like your underwriter fee and some other registration, some other fees. So let's say flotation costs, right? So you don't receive the money in full amount. So let's see an example here. Okay, let's say you're going to issue a stock, uh, and you notice that similar stock similar stock by another company has paid current dividend of whatever 300, right? It's expected constant to have a constant growth forever at whatever 3%, right? And then you are expecting to get I don't know, maybe 7,000 a piece, right? Okay, so now the question is how much flotation costs or fees that you have to pay, right? With respect to the issuance of your new equity. Say the flotation cost is like 5%, right? Okay, let's put into required return by new equity holders be the old one 300 and expected to grow at 3%, right? This is the next dividend, right? Divided by is 7,000, right? 7,000. However, it will be cut the flotation cost of 5%, right? Times plus the constant growth forever 3%. So how much will we get? $7.65. Okay, 7.65%. So this is the cost of this is what required return by uh, new stockholders, or to us, this would be the cost of new equity, right? So actually, it's the same as the cost of existing equity, but we make an adjustment to the flotation cost, right, as the denominator. Okay, so we have seen all the typical components. We have seen the cost of debt, cost of preferred stock, and then cost of common stock or common equity. Of course, there are a lot of variations. There are a lot of adjustment to be made in real practice. So in real practice, we want to be quick, we want to be accurate, so we do a lot of variations and adjustment. But again, theoretically, we have seen all the typical models that we could adjust or modify uh, depending on what you need in the real practice. Okay, so We are going to combine all of them. Uh, right. So we have the cost of capital, right? Cost of capital. So should be a combination of everything, right? So we have the first item would be the cost of debt, right? So required return by creditors, right? Okay. So before we go further, uh, there's one special thing about the cost of debt, right? Before we add them together. So cost of debt has a special benefit, uh, plays an important role, and it benefits the company in the realm of taxation. Okay, so let's repeat a little bit about the accounting. So I hope you still remember your income statement, right, or profit or loss statement. We have your revenues, you have your cost of sales, right, cost of goods sold, or cost of services delivered, and another name maybe, but the cost of sales, right, and then you get your gross profit. Okay, so after the gross profit, okay, after your gross profit, uh, you have uh, other operating expenses, right? Operating expenses, including your depreciation and amortization expenses. You get your operating profit, right? Operating profit, and then you plus or minus your other loss or income, right? Other loss or income, and then you get your EBIT. So let's assume that we don't have, or the amount of your other loss or income is insignificant, then your operating profit is your EBIT, right? Your earnings before interest and taxes. So once again, it should be operating profit, and then you adjust your operating profit with other loss or income, and then you will get your EBIT, right? Your earnings before interest and taxes. And then, as the name suggests, right, earnings before interest and taxes. And the next one would be your interest expense, right? Interest expense. Then you get EBT, earnings before tax or taxes if you have state and federal taxes, right? Earnings before tax, you minus the tax, and then you get your uh, net income. Then you adjust your net income with the other comprehensive income, and you get your total comprehensive income. But we'll stop here. You see the fact here. Just bear with me for a while. If you increase your debt, you increase your borrowing, then where's the logic there? The interest expense that you have to pay will be higher, right? So if you borrow more and more money, then the interest expense that you have to pay will be higher. So assuming that your EBIT remains the same, but your interest expense is higher, then your EBT would be lower, and consequently, the your tax liability or tax payment will be lower as well, right? So coming back to our story here, so the use of debt financing, benefits the company uh, in the sense that it will lower the tax payment by the company. That's why cost of debt will get the tax discount to reflect the tax benefit brought by the debt financing. So the clean cost of debt is the the usual or the normal cost of debt that has been deducted by tax, right? So it's tax deductible. So for example, if our cost of debt is, let's say, 7%, if the tax rate of the company is 30%, then the net cost of debt would be about 4.9%, right? Or 5%. Okay. So this is the net cost of debt, because the cost of debt brings the taxation benefit to the firm, because it will lower the tax payment of the firm. That's why the cost of debt gets tax discount, or is tax deductible. Okay, so it's quite interesting, right? If you think about it again, if you think further, what if I use less debt financing? I borrow less money, so my interest expense will be smaller or lower. Then my EBT would be higher, and the tax payment would be higher, right? So if you think about it, there are two choices here. The first choice is you pay more interest expense because you borrow more money, but you pay a lower tax, right? And the second choice is you use less debt financing, so you borrow less money, so you pay lower interest expense, but you pay higher or a higher tax, right? But in finance, in accounting, in economics, we always choose this one. We're saying that this is uh, more ideal to the company. If you follow our discussion on capital and investors, you'll know, uh, yeah, instantaneously know that the allocation money is important, right? So interest expense is paid to our creditors. Are the creditors our investors? The answer is yes, right? So interest expense is paid to creditors. The creditors are our investors. What about the tax payment? Tax payment is paid to the government, and the government is not our investor. Okay, so if we are to allocate money to again allocate the money to divide the spoils, then we have to prioritize our investors, right? This is, I think, the basic business philosophy, right? Okay, so coming back to the story here, cost of debt is tax deductible because it benefits the company by lowering tax payment. Right? Yeah. Plus cost of preferred stock, if any, right? Plus it may be too far away, so let me rewrite this. Okay, so cost of debt, but it should be tax deductible, right? Plus cost of preferred stock, if any, plus cost of equity, right? Or the existing one, right? Plus cost of new equity, if any, right? Of course, we add them together. We multiply each by its respective weight. Right? How much financing that comes from debt, right? For example, yeah, on the right side of our balance sheet. So how much debt constitutes the total capital that we have, and then how much for preferred stock, if any, right? How much is the proportion of equity, and how much is the proportion of new equity, if any? So because we multiply each by its weight before adding them together, then the name is weighted average, right? That's why we call it what? Weighted average cost of capital. Okay, weighted average cost of capital. Or the famous term, right? WACC, that we will always use in the business valuation, in the feasibility study, or anything like that. Okay, so again, this is the cost of the weighted average cost of capital, because we find the cost of capital by weighting all components by their weights. Right? Okay, one last thing before we finish our session. So if we are to make an order of the cost components, right, from the cheapest to the most expensive. Interestingly, what we have done here has been the order, right? We don't plan for it, but it's already the order from the cheapest to the most expensive, right? Even without numbers, without calculation, we can prove it easily. Right? We have here, right? We have the preferred stock, we have the common stock, right? So you see, let's compare this one first, right? Cost of debt and cost of preferred stock. Again, I come back to the two simple questions, right? So if we borrow money, are we required to pay the interest payment? The answer is quick yes, right? And are we obliged to pay on time? The answer is yes. What about the preferred stock? Are we required to pay preferred dividend? The answer is yes. But are we obliged to pay on time? The answer is no, because we could delay it. We could defer the payment to the next period. So think about it. If you are if you were a creditor and compare the situation to uh, the situation where you were a preferred stockholder, which one would be safer to you, knowing the facts, right? The two simple questions. Of course, being a creditor is safer, right? Because you know that you will receive the interest income on time, and your debtor is also obliged or required to pay on time. So you feel safer. Because creditors are safer, at the position of a creditor is safer, then the creditor will ask for less, right? Naturally, a creditor will ask for less, right? And to the company, of course, the cost of debt will be lower than the cost of preferred stock. And you see, additional fact, this additional fact tells us that even the cost of debt is tax deductible. So it's already cheap, right? It's already cheaper than preferred stock, let alone uh, getting the tax deductibility. So even cheaper, right? The cost of debt is already cheaper than the preferred stock naturally. And in fact, it also gets the tax deductibility. So it's even cheaper. Okay, what about the preferred stock, cost of preferred stock compared to cost of equity? Again, simple question. Right. Are we required to pay a preferred dividend? The answer is yes, but we are not obliged to pay it on time. We could defer the payment. What about the equity? Are we required to pay the common dividend? And the answer is even no. So obviously, being a preferred stockholder is safer than being a common stockholder. So a preferred stockholder naturally will ask for less. Right? So the cost of preferred stock to our company will be lower than the cost of equity, because again, the common equity holders, common stockholder, we ask for more than do the preferred stockholders, right? So cost of preferred stock is lower than the cost of common equity, right? So you see fact here, and of course the cost of common equity will be cheaper than the cost of new equity, right? Because we have to pay for the flotation cost. So you see, we don't plan for it, but the order that we are making here has reflected, you know, the order from the cheapest to the most expensive cost, even in the natural consideration or natural estimation, right? Even without numbers. And we another proof. Again, you can imagine, right? If something happens to the company and we have to liquidate the assets, liability holders or the creditors will get it first, right? We get the amount of money, right, from the liquidated assets first, followed by the preferred stockholders, followed by the common equity holders or common stockholders, if any, if any money remaining, right? Okay, so creditors are safer, position as a creditor is safer than that as preferred stockholder, and of course, the position as a preferred stockholder is safer than that as a common equity holders or common stockholders. Okay, so I hope our discussion today is clear and uh, could help you, dissect, you know, the information and knowledge about the cost of capital that we'll always use again for valuation, for feasibility, evaluation, and so forth. Okay, thank you very much for attending the session. See you again in the next topic. Bye.